Hello, welcome to another talk on money, business, and investing. My name is Jose. I'm the founder and chairman of Master Investor. Welcome to our community. Ensure to go to our website, get our digital courses, ebooks, financial tools, and the data that we have available with the opportunities to create true wealth for our community. Today's topic is going to be how to be a wealthy investor. Pursue financial education to become an inside investor, also known as a wealthy investor or creative investor. Not all investors are made equal. Summary. Wealthy investors are characterized by their financial intelligence rather than their income or luck. 2. Wealth starts with the right mindset and education well before making any investments. 3. Anyone can become a successful inside investor by understanding how money operates. We will discuss the bonus topic, what is the foundation to become wealthy, at the end of today's discussion. Many aspire to be wealthy investors, but few understand what truly distinguishes the wealthy from others. It is not merely about luck, connections, prestigious degrees, or high-paying jobs. Master Investor's company has emphasized for a long time that becoming a successful investor begins long before purchasing stocks, rental properties, or businesses. It starts with one key element, financial intelligence. While many people invest, few do so wisely. Anyone can contribute to a retirement plan or a savings account, or speculate on trendy stocks. However, wealthy investors perceive opportunities long before others do. We comprehend risk in a way that safeguards our investments. We generate passive income and capital gains income not solely because markets rise, but because we understand how money functions. This type of mindset is accessible to anyone willing to learn and put it to practice daily. The mindset that distinguishes wealthy investors. Before exploring strategies or financial options, it is essential to adopt the mindset of a wealthy investor, characterized by clarity, courage, and financial education. Number 1, wealthy investors prioritize cash flow over comfort. Many people invest for comfort, thinking they hope their 401k will be sufficient or they want a safe return. In contrast, wealthy investors focus on freedom, managing risk, raising capital, control, and achieving high returns on investment. We seek assets that generate monthly passive income now, not just in retirement. We choose investments that enhance our passive income rather than merely our savings. To do this successfully, we must be an active investor and not a passive investor. Mastering the art of raising capital is part of being an active investor. We have to attract good money into our investments. A wealthy investor considers the following. Will this investment provide cash flow, and how fast? Positive cash flow offers control, options, infinite return on investment, and time, which is the ultimate form of wealth. 2. Wealthy investors conduct thorough research before making investments. Master Investor stated previously, inside investors require information, not just money. The most important words in the business language are cash flow and due diligence. In contrast, less affluent and average investors often invest without understanding the opportunity. Wealthy investors, we take time to analyze the data and fully comprehend how an investment operates before committing. Doing the due diligence is key for investing. Financial education mitigates risks, while uninformed investing increases risk. The Master Investor Company consistently offers that those who accumulate wealth are those willing to learn, practice, and reassess our financial beliefs. Everything changes along the way. The new rules of money have emerged. We have new laws coming into play regarding money in the past decades. And so we need to update ourselves with the wealthy mindset and the changes in the law along the way. Number 3, wealthy investors take charge of our finances. Many individuals around the world rely on others for their financial futures, such as financial advisors, fake teachers, employers, parents, government retirement systems, or spouses. Wealthy investors understand that no one is more invested in our financial freedom than we are. We take ownership of our financial knowledge. We learn to analyze and improve financial statements, assess deals independently, and view our finances like a business owner evaluates a company's performance. When someone else manages our money, they influence our future. Wealthy investors, we choose not to relinquish that control. Investors can be designated as either wealthy or poor based not on our wealth but on our mindset. Poor investors, they prioritize savings, fear losing money, depend on guarantees, follow popular trends, perceive investing as risky, rely on hope for long-term capital gains income, invest with opinions rather than facts, seek security, avoid risk, lack financial education, lack financial experience, and lack excess of cash flow. Wealthy investors emphasize cash flow, learn from setbacks, create opportunities, think independently, utilize financial education to mitigate risk, build wealth through income-generating assets, invest with OPM, other people's money or good debt, minimize taxes to zero legally using the tax code and the corporate laws. Know the difference between facts and opinions. Know the difference between assets and liabilities. Master reading and improving financial statements. Invest only with a winning business plan that has a lucrative exit strategy. The distinction is clear. Poor investors seek safety, while wealthy investors, we seek control. To gain control as business owners and inside investors, we need to understand the 8 key terms for building real wealth. Refer to the diagram below to explore these essential terms found in any financial statement. The terms are as follows. Number 1, income. Number 2, expenses. Number 3, cash. Number 4, assets. Number 5, liabilities. Number 6, net. Number 7, buy-in. And number 8, credit. We can see the diagram in front of us, and we can tell that these 8 essential words are critical when it comes to financial statements. The 5 types or levels of investors and their strategies. MasterInvestor identifies 5 types or levels of investors. Everyone fits into one of these, consciously or not. Number 1, novice investor. They have no clue about how money works and they lack financial education. They think investing is too risky to even start. They have no passive income and capital gains income from investments. Number 2, saver or passive investor. They entrust their money to others, like financial advisors or retirement plans, hoping for positive outcomes without taking responsibility. They do not like to be active at investing. Instead, they allow others to handle their money for them. Number 3, amateur investor. They attempt to select stocks, follow market trends, and often speculate, believing they have no control when they do not. They invest without a winning business plan. They utilize opinions rather than facts to invest. They don't know how to read and improve financial statements. 4, professional or active investor. We possess market knowledge, can analyze data, and assess risk effectively, treating investing as a skill. We are active in the investing process. We have control over the assets and liabilities. Number 5, capitalist investor. And this is the highest level of an investor. This is what here at Master Investor we thrive to be, a capitalist investor. That's the highest level of an investor. It is the wealthy investor. It is a master investor. It's a creative or insight investor. We go beyond mere analysis by creating opportunities, building teams, leveraging resources wisely, and investing in unconventional assets. We master the ability to raise capital and invest it for passive income. We influence markets rather than being influenced by them. We can create money from thin air by reaching infinite return on investment from our ventures. A capitalist investor is a wealthy or insight investor. We are creative when investing and we maximize our return on investment. We can create money from thin air using good debt to invest for passive income. We understand the corporate laws and tax code for wealth building. We only invest with a winning business plan that has a lucrative exit strategy. We use facts over opinions to guide us in our decision making. We conduct thorough due diligence on our investments. We have the ability to take a company public and sell the shares to the masses. This approach leads to a true financial freedom and true wealth. 3 skills every wealthy investor should master. Anyone can become a wealthy investor by mastering 3 essential skills. Number 1, identifying strong investments. Wealthy investors develop the ability to see opportunities that others overlook. While opportunities are abundant, a lack of awareness can obscure us. We learn to recognize value, understand market cycles, analyze financial statements, and pinpoint deals that generate significant cash flow. Number 2, assessing risk and reward. Wealthy investors do not shy away from risk. Instead, we manage it through knowledge and experience. We understand the numbers, are aware of potential downsides, and always have an exit strategy in place. Number 3, raising or leveraging capital. This skill distinguishes the wealthy from others. A successful investor knows how to utilize other people's money, also known as OPM, good debt, partnerships and teams, tax advantages, other people's time, also known as OPT. Master Investor emphasizes that the ability to raise capital is often more crucial than simply having money and investing our own capital. The lazy and financial uneducated people uses their own money to invest. That's all they use. They don't know how to utilize a credit card or a loan to invest for passive income. In fact, when we have financial education, we can combine our capital with other people's money, with debt, to invest for passive income. We use our capital to raise more capital, to go into good debt so that we can acquire a bigger asset that cash flows even more than the asset we would have been able to get just with our own capital. However, when we use other people's money and our capital, then we have more leverage. The number 1 job of a wealthy investor is to raise capital. And the number 1 skill is to sell without selling, using systems and smart marketing. That's what's important, that we continuously invest in our financial education and self-development. Financial intelligence is more important than money. The Master Investor Company emphasizes that it is financial intelligence, not money, that leads to wealth. Individuals with high financial intelligence can recover from significant losses, while those with low financial intelligence may quickly squander newfound wealth, such as lottery winnings. Key aspects of financial intelligence include reading financial statements, understanding taxes, differentiating between assets and liabilities, using debt wisely, legally protecting money, asset protection, identify opportunities, catching new trends, adopting an investor mindset rather than an employee mindset. Wealthy investors consistently enhance our financial intelligence each year, as ongoing financial education provides a lasting advantage in a constantly changing world. The journey to becoming a successful investor takes time and is accessible to everyone who wishes to become a wealthy investor. 3 types of income. We have earned income, is taxed at the highest bracket. That type of income comes from selling time for money. It literally comes from having a job or a salary. The person doesn't show up to work, he or she does not get paid. That is earned income, and it is very hard to become wealthy just with that income because the person can only work so hard every single day, and usually there's a cap on how much money they can make per hour. The second type of income is capital gains income, and that comes from an investment that we make successfully and we sell the asset for a higher price than we purchase it. And those profits are called capital gains income. That is a one-time profit, and we pay taxes on that higher than passive income. The taxes on capital gains income is lower than earned income, making earned income the highest tax income of all the 3 types of income that exist. And then we have passive income, which is the income that is taxed at the lowest bracket, and it literally gives us the ability to build tax-free wealth legally. We want to be focused on passive income primarily, and then as we move along, we will obtain assets that create capital gains income as well, because in certain asset classes, with certain assets, can only make us capital gains income. We will know the difference even before we commit to the investment. Are we getting capital gains income or are we getting passive income? Again, let's focus on building passive income because that is going to increase our financial intelligence, and it's also going to position ourselves to be building true wealth. And we want to have positive cash flow coming in even when the economy is down, because we have different assets and different asset classes that are producing passive income because they are solving a problem in the world. Every business or investment is solving a problem in the world. It has a product that people want, and we have systems that are working hard to do the selling and telling for us on autopilot, serving that product to the masses. Begin with financial education. Read books, analyze investment deals, and familiarize ourselves with key terms. When people are familiar with concepts like cap rate or cash on cash return, infinite return on investment, leverage, good debt, OPM, OPT, tax-free, cash flow, assets and liabilities, etc., they are not prepared to invest. Focus on mastering these 4 foundations of financial education. Number 1, distinguishing between assets, liabilities, facts, and opinions. Number 2, understanding cash flow, also known as passive income versus capital gains income. Number 3, utilizing good debt and taxes to build wealth. Number 4, taking charge of our financial decisions. Start with small steps. A knowledgeable investor gains experience through action, even if those initial steps are minor. Many begin with a small rental property, a dividend-paying stock, a straightforward side business, a small investment in crypto or commodities that we fully understand. Financial education combined with a winning business plan and action leads to financial experience. Form a team. Business and investing are team sports. Wealthy investors do not invest alone. We collaborate with accountants, attorneys, brokers, partners, banks, government, advisors who are also investors. A strong team safeguards wealth and fosters improved opportunities. A sound business is a system of systems. Wealthy investors look for businesses that are composed of a system of systems doing the telling and selling for us on autopilot. We understand that a business without proper systems is not a true business. There are many systems to take in consideration when building our businesses. Today, it is easier than before to acquire the proper systems for our investments due to technology being so advanced. There are AI systems that can automate and positively impact our businesses' cash flow or bottom line. Transition from saving to actively acquiring assets. In essence, savers do not succeed in building wealth. Wealthy individuals, we grow our fortunes by acquiring assets in different asset classes such as real estate, business, crypto, paper assets, and commodities. Those are the 5 asset classes that exist today. And it's not only diversifying in one asset class that makes us successful. What truly makes us successful is that we go into all the different asset classes and we acquire sound assets for passive income and sometimes capital gains income. But we are diversified among the 5 different asset classes. Keep that in mind because majority of people talking about money in the world, they tell their communities to diversify in just one asset class. And here at Master Investor, we encourage our members and community to diversify among the 5 different asset classes. Because when one asset class is not doing well and the economy crashes, we have other asset classes that do very well when the economy is down and when the inflation rises, right? We need to have asset protection by utilizing as much diversification in different asset classes with real assets that we are controlling for passive income. Now, we only invest with a business plan because investing is defined as having a winning business plan and a lucrative exit strategy. Therefore, only average investors invest without a plan, and that's why they get average results. In essence, savers do not succeed in building wealth. Wealthy individuals will grow our fortunes by acquiring assets, real assets in different asset classes. Our main focus is on acquiring cash flowing investments. Keep this principle in mind. Assets increase our wealth monthly while saving diminish in value annually due to inflation. A lot of people think that their savings is making them wealthier, and it's not, because they loosen with inflation and they are paying interest just to have their money saved in the bank. They're paying a fee. And so at the end of the year, the saver is the loser, and the one that knows how to utilize debt, how to put that money into a real asset, how to allocate capital and real assets. That is what's going to make the difference between the average and the wealthy investor. We allocate money constantly, actively. We're always looking to move money from an asset to asset because that is how money maintains its value today. Since it's not longer backed up by real money like it used to before August 15, 1971, it was backed up by gold. On that year, President Nixon separated the gold standard from the US dollar. From that point forward, money became monopoly money, fiat money, fake money, paper money, and just an idea backed up by confidence. Therefore, we need to utilize the new rules of money, have a winning business plan, combine debt, understand how to manage risk, and actively invest to acquire cash flow generating investments. Again, assets increase our wealth monthly while savings diminish in value annually due to inflation. Embrace calculated risk. Safe investments can often be the riskiest. Wealthy investors focus on understanding financial dynamics rather than fearing losses. Managing risk is essential, not avoidance. Prioritize positive cash flow. Positive cash flow is the consistent income generated from investments, also known as passive income. It sustains us during economic downturns and shields us from inflation. At Master Investor, we advocate for cash flow as the optimal investment income. as it provides true financial freedom by allowing us to reclaim our time and energy. This is the path to becoming a wealthy or inside investor. Remember, we measure wealth with time. How many months, how many days can we go without working for earned income and thrive with passive income and the funds that we have available right now? How long can we go without having to work and still be able to pay for all of our standard expenses that we have, and everything that we have going on in our lives is being paid with the passive income and the funds that we have available right now? How long, how many months can we go? Majority of people can't even last 3 months without running out of money. And that's how wealthy a person is the amount of time that we can go without working and still be able to thrive with the standard of living that we like to have, and without decreasing that. In fact, we can increase the standard of living even though inflation continues to rise. We use it as a tool because we're not only using our own capital to invest, we're utilizing debt, OPM, other people's money, we're utilizing other people's time to manage our businesses, to grow our businesses, right? And create more cash flow for us. Making the shift. The Master Investor Company has dedicated years to teaching a fundamental principle. Anyone can become a wealthy investor by learning the rules of money. Becoming a wealthy investor relies not on having more money, but on increasing financial intelligence. It involves prioritizing cash flow over comfort, financial education over excuses, and responsibility over dependence. When individuals make this shift, they transition from being victims of the financial system to becoming creators within it. This is the pathway to joining the ranks of wealthy investors. Bonus question: what is the foundation to becoming wealthy? Understanding our personal financial statement is essential for financial success. Here is a free template to help us begin. You can also find the template on our website. Make sure to go over there, download a personal financial statement that is blank, and fill it out because it is going to help us understand where we are financially so that we can begin building a winning business plan. And that is really the first step. Understanding our personal financial statement can be straightforward. Wealthy individuals excel at interpreting our financial statements. The first step is in understanding our personal financial statement is to grasp the connection between the income statement and the balance sheet. As we can see, the simple diagram in front of us, we have a financial statement, we have the income statement showing, we have the income column, the expenses, and then we have the balance sheet with the assets column and liabilities column. What does it mean to be wealthy? This is a crucial question. For many, being wealthy equates to earning a lot of money. They believe that a slight increase in their monthly income will resolve all their problems and allow them to live comfortably. Financial literacy starts with understanding our personal financial statement. However, money alone does not determine wealth. True wealth comes from our financial intelligence. If we give 1 million to someone with low financial intelligence and to someone with high financial intelligence, we will notice a significant difference in how each manages and grows that money. The key distinction between those with low and high financial intelligence lies in a fundamental skill, the ability to comprehend and improve financial statements. And that is the foundation of true wealth, being able to read and improve financial statements. Personal financial statement tracks our income, expenses, assets, liabilities, and cash flow. Understanding these elements is essential for assessing our financial position and assessing investment opportunities. The Master Investor Personal Financial Statement, available for download, illustrates the connections between these concepts. Without grasping these ideas, success and investing relies on luck and gambling rather than skill. Many accounting classes teach how to read income statements and balance sheets separately, but they often fail to explain how these documents interact and influence one another. Master Investor emphasized the importance of understanding this relationship. We question how one could comprehend assets and liabilities without considering income and expenses. For us, recognizing how these elements relate helps clarify cash flow, direction, and whether an investment is profitable. If an investment generates income, it is an asset. If it does not, it is a liability. Master Investor noted that not everything listed as an asset truly qualifies as one. Financial struggles often arise when individuals purchase liabilities but categorize them as assets. The focus should be on how much we retain expenses, not just what we make income. While high income is generally seen as positive, the wealthy, we perceive it differently. Similarly, low expenses may seem advantageous, but the wealthy view it as a negative. This misconception often leads high earners like C-suite executives to adopt a poor mindset. As Master Investor stated, money is just an idea backed up by confidence. Recognizing that low income and high expenses can be beneficial is crucial for understanding money's true nature. Failing to grasp this concept can lead to financial downfall, even for the wealthy. So we need to understand that having low income and having high expenses is key to building true wealth, because not only that we don't want to pay taxes on taxable income like it is earned income. That's the type of income that majority of people tend to build, which is the one that comes from a job or selling time for money. And they have no room to minimize taxes. They literally have to pay the taxes ahead of the day that they get their check. Even before they get paid, the taxes have already been withdrawn from their money. So taxes for the poor mindset and those on the left side of the cash flow circle does not help them. Okay, so taxes do not help the poor mindset and those playing on the left side of the cash flow circle. Taxes do help the wealthy mindset and those on the right side of the cash flow circle, investing for passive income and sometimes capital gains income. We use the tax code and the corporate law to create even more wealth because we are doing exactly what the government wants us to do, which is to invest in different sectors in the economy to improve the economy and the areas that they're passionate about improving, okay, for the economy and for the world. So we need to pay attention to the laws. We need to speak the lingo of money so that we can attract the professionals to help us fulfill the mission of our businesses. Consider the 98-3 rule. Around 98% of people earn only 3% of the world's wealth. In other words, only 3% of the population controls 98% of the world's wealth. To be a wealthy investor, we must effectively manage our income and expenses, making investing a priority for our expenses column. Operating on the right side of the cash flow circle will put us on the 3% of people who controls majority of the world's wealth. If a person lacks understanding of money and its mechanisms, it may seem unusual that the ultra wealthy have low income and high expenses. We might wonder how low income and high expenses can lead to wealth. The answer lies in how sophisticated or inside investors leverage tax and corporate laws to convert those expenses back into income on our financial statements, and specifically back into passive income. And again, sometimes we will obtain capital gains income, but we are focused on building passive income. Keep it super simple. One of Master Investor's key abilities is to simplify complex business and investing concepts. We emphasize the principle of KISS, keep it super simple. Here are Master Investor, we have a talent for breaking down complicated financial topics so that even a young child could grasp them. For instance, Master Investor uses straightforward diagrams to show anyone about the connections between the income statement and the balance sheet, which we can utilize today with our financial statements. So understanding the following diagrams can significantly enhance our chances of building wealth. Cash flow patterns. An asset is something that generates income into our pocket, while a liability is something that incurs expense or takes money out of our pocket. Now, an asset can only be determined to be an asset when it's making us passive income, and we don't have to be present to make that passive income because we have a system and systems in place and the asset that is doing the selling and selling for us. Again, there's nothing wrong with having a lot of expenses. In fact, we want to have high expenses and low earned income. And when we make passive income and capital gains income, we're rolling that over into new investments with a business plan and in different asset classes so that we can minimize taxes all the way to zero, because we're literally constantly moving the money from asset to asset. And that gives us an unfair advantage because the laws and the tax code are on our favor, because the rules of money were created by the wealthy to favor the wealthy. And there's nothing wrong with understanding that there are two types of mindset when it comes to money. We have the poor and the wealthy mindset. There's nothing wrong with having a job and wanting to go down that route. Or if an individual wants to become a business owner, an inside investor, then we have the answers. We have the tools, the data, and all the elements necessary to create true wealth. It is something that is personal for everybody to decide what side of the cash flow circle do we want to operate. Do we want to be on the left side, or do we want to be on the right side of the cash flow circle? Understanding that in the left side, we find the middle class and the poor class, the employee and self-employed, right? And then we have on the right side, the business owner and the inside investor. And wealth is built on the right side of the cash flow circle. People work for earned income on the left side of the cash flow circle as an employee or self-employed. And taxes are the highest on the left side of the cash flow circle because they are building earned income. On the right side of the cash flow circle, we are focusing on building passive income and capital gains income. MasterInvestor noted that confusion arises because traditional accounting practices allow both assets and liabilities to be listed under the asset column. To clarify this, we created a simple diagram. So we can see it in front of us. We have the financial statement showing the income statement and the balance sheet. People houses are often considered an asset, but it can actually be a liability. This is where the confusion arises. In this example, we have a $100,000 house with a $20,000 cash down payment and an $80,000 mortgage payment. How do we determine if this house is an asset or liability? It is an asset simply because it appears in the asset column. The answer is no. To clarify, we need to check the income statement to ascertain whether it is an asset or a liability, which way the cash flow is flowing, out or into our pockets. Here's a simple diagram of a financial statement and what an inside investor or wealthy mindset individual aims to achieve. As we can see, the same financial statement that we view above, we have it in front of us, and we have an arrow going from the assets column on the balance sheet into the income column. A lot of people, they have a job, and that job gives them the income, and they have no assets in the assets column, and that's the only income that they work for. And that's when the issue comes in. They have to actively be working to generate more money. As an inside investor, our focus is to building the assets column. We literally spend all of our time acquiring and building assets that produce passive income and sometimes capital gains income. Once we grasp the insights from this diagram, we will recognize a pathway to increasing financial abundance. This diagram illustrates how wealthy individuals invest our income in assets and expenses that generate additional income through cash flow. This income is categorized as passive income, which is taxed at a lower rate compared to earned income. Furthermore, these assets can be held in entities that offer significant tax advantages. Consequently, while we may be very wealthy, our income levels do not match those of a high-paying employees because we are constantly redirecting our income from our investments into other investments. Our investments that are successful are buying other investments that are also successful, and we're creating more expenses, good expenses, that we can deduct from our taxes legally. We must remember the following about control. A key measure of control is understanding what percentage of our expenses returns to our income column within the same month. By adopting MasterInvestor's perspective, we will uncover a different reality, one that contrasts sharply with the experience of those who work hard, earn substantial salaries in the form of earned income, and manage their expenses. This is a world of growing wealth rather than diminishing returns. The financial statement of a wealthy class individual, only around 3% of the entire population understands how to achieve this type of financial statement that demonstrates true wealth in action as it is shown in the simple diagram below. We must possess the wealthy mindset, which allows us to create true wealth. And also, it gives us the ability to see the world with our minds rather than with our eyes. The cash flow pattern of the wealthy class. We can see the diagram here. It is showing the income statement, the balance sheet, the income column, the expenses column, the assets column, the liabilities. We have an arrow going from the assets column, pumping in cash flow into, or also known as passive income, into our income column, and that income is flowing into our liabilities, and then that income continues to go up into our expenses column, and in that those expenses go out into our assets column. Okay, a lot of people don't know how to do this, to create expenses and turn liabilities into assets that generate more passive income. In this financial statement, the positive cash flow comes from passive income and capital gains income assets that we control with our companies. We have the ability to turn certain expenses and liabilities to sound assets, redirecting them back into our assets column. And that is key. And that is something we must remember about control. A key measure of control is understanding what percentage of our expenses returns to our income column within the same month. The financial statement of a middle-class individual compared the diagram above with the traditional perspective on money. Majority of people around the world, they are considered to be middle class. The poor and middle class are becoming one class, the poor class operating with the poor mindset. Money alone does not determine our wealth number. Too many people with money, but they don't know how to make money through investing with their money. As the poor mindset lacks financial education, then it becomes difficult to invest wisely and manage risk. Compare the diagram above with the traditional view of money. Most people globally are considered middle class. The poor and middle class are merging into one group, the poor class operating with the poor mindset. As we can see, the cash flow pattern of the middle class. We have the income statement, we have the balance sheet again showing, but a very different form of managing the cash flow. We have no assets on the assets column for the middle class. On the balance sheet, they have liabilities. On the income, they have income coming in from a job, or it could be a doctor, a dentist. They have their own practice. That's a self-employed individual. They still have to show up to see their clients and make money. If they don't show up, they don't make money. And that is earned income. It is taxed at the highest bracket. And they lack systems too. So they have to show up every day to make money. And the income comes from a job. It goes down to the liabilities column, up to the expenses column, and it goes to someone else's asset column. Unlike to the wealthy class individual, we were able to bring the expenses back into our assets column. And that is achieved through financial intelligence. This diagram represents the financial situation of a significant portion of the global population. Income flows into the income column from a job or a salary and exits through the expense column. Without returning, this is why many individuals attempt to budget, live within their means, save money, and reduce expenses. That is the opposite of building true wealth. The financial statement of a poor class individual. Similar to the middle class, the poor class manages the cash flow with the poor mindset. The poor class relies on earned income from a job or a salary. They don't have credit to acquire liabilities because they don't make as much as the middle class makes on their jobs. Therefore, they simply work for earned income to pay for their regular living expenses, and they repeat the cycle. So we can see the cash flow pattern of the poor class diagram is in front of us. It is very similar to the one of a middle class individual, where the income comes from a job, goes into the income column, and then instead of going to the liabilities column, it goes straight down to the expenses column and into someone else's asset column. So they just lack assets, liabilities, and they lack financial education, right? Because they don't know how to raise capital. They don't have capital to invest because they're paying taxes and they're paying everybody else first, and they are left with nothing at the end of the month. And they repeat that over and over again. Consequently, people often refer to their home as assets, despite the fact that expenses related to home ownership do not generate immediate returns. This also clarifies why individuals might say they are losing money each month, but the government provides a tax break for their losses, instead of stating, I'm earning money on my investment and the government offers a tax break for my gains. That is a very different type of mindset. We're describing the poor mindset and the wealthy mindset. Only those with the wealthy mindset and a winning business plan will achieve tax-free wealth. Understanding why a person's personal house is a liability can be illustrated through this diagram created by MasterInvestor that is in front of us. We again have the income statement showing the income column, the expenses column, we have the balance sheet, and we have the assets and liabilities column. On the assets column, we have listed a $100,000 house. On the liabilities column, we have the mortgage of the house, which is $80,000 mortgage. And on the expenses, we have mortgage payment, rental estate, real estate taxes, insurance, utilities, and maintenance. As we can see, the problem with this is that the owner of this house has it listed on the assets column as an asset. A house is their asset, but there's not rental income coming from their house. It is the bank's asset, their liabilities, the mortgage that they have, and the expenses of the house that they have to pay every single month. They're paying for it. They have to get up and work for earned income to be able to pay for the house expenses. And that is a liability because it's not putting money into their pocket. Even if the house is going up in value due to inflation and the market rising, that still does not qualify their house as an asset, because remember, an asset must put money into our pocket today, not tomorrow, no in the future. Right now, we need to receive that passive income. Otherwise, it's not an asset. And as a liability. The house is considered an asset of the bank, but not always an asset to the homeowner or investor. MasterInvestor added rental income and net rental income to the diagram below, emphasizing the term net. This change transformed the house from a liability into an asset on the financial statement. Now, if the homeowner is creative and now rents out part of the house to short and long-term rentals, then now the house becomes an asset if we can create positive cash flow after all expenses are paid with the income that we're getting from the rental income, from the tenants that we're going to be having in our place. And when that happens and we have passive income coming in at the end of the month, and that is used to pay for the expenses of the house, the mortgage, the real estate taxes, insurance, the utility, the maintenance, and whatever is left is positive cash flow, then that house will be considered an asset to us because now it's putting money into our pocket. The mortgage is being paid with the rental income. Everything about the house is being taken care of through the rental income. In other words, we don't have to work for earned income to pay for the house. The house debt is being paid on its own, and that is what determines whether it's good or bad debt. And we want to be able to manage good debt so that we can acquire liabilities that carries bad debt. There's nothing wrong with having luxury items and things that we want to have in our lives, as long as we have real assets that are producing cash flow to pay for those liabilities, and we can have everything for free and legally because we are positioning ourselves with the wealthy mindset in the world. And only about 3% of the individuals around the world have this type of mindset. MasterInvestor clarified that if the rental income from a property after deducting expenses results in positive net income, cash flow, then the property is considered an asset. The net income minus all expenses is considered the cash flow. If it does not generate positive cash flow after expenses, then it is a liability. Majority individuals who owns a house owns a liability, even though they believe that it is an asset. If the homeowner or investor does not put the house for rent to others and turn it into a real estate business, then it is a liability to them and an asset to the bank. That is a simplified view of our personal financial statement. These straightforward lessons are significant and form the foundation for building substantial wealth. A person with a high financial IQ and $1 million knows how to invest in true assets that generate monthly passive income. Conversely, and sometimes capital gains income. Conversely, someone with a low financial IQ may spend that money on liabilities without recognizing the issue, leading them to work harder to earn more, creating a cycle known as the rat race. Understanding the connection between the income statement and the balance sheet through our personal financial statement template enables us to quickly determine whether an investment is an asset or liability, empowering us to make informed investment decisions. Today, consider that what percentage of our money moves from our expenses column back to our income column within the same month. By grasping this concept, we will unlock the potential for growing our wealth continuously. For additional insights on our personal financial statement, refer to our ebooks, data, and digital courses available on our website. Start investing in high-quality financial education by reading our financial ebooks. We have 3 available right now: the 10 New Rules of Money, How to Build Cash Flow with the Internet, Turn Passive Income On, How to Invest in Crypto to Build Wealth, Understanding Bitcoin and Blockchain, the Rise of Legitimate Reserve Digital Currencies and Assets. We have different tools and resources available on our website. We have our podcasts, Instagram, newsletter, YouTube, TikTok, courses, Facebook page, Discord, and our inner circle. Make sure to reach out to our team if you need help with business plans or if you need a consultation about creating financial freedom and true wealth. Make sure to reach out to our team. We're available 24/7 to help out our community and our partners. So the 8 essential words for true wealth: income, expenses, cash, assets, liabilities, net, buying, and credit. Being able to read financial statements and improving them, that is the foundation of true wealth. So today's message is how to be a wealthy investor. The first thing we need to do is increase our financial intelligence, because Money alone does not make us wealthy. We need to have financial intelligence. We need to put that into practice. We need to have financial experience. We need to invest only with business plans that have an exit strategy. For every investment that we embark on, we need to know everything about the investment, know the difference between an asset and liability, opinions and facts. Always invest with facts. And make sure to keep close the foundation, the four foundation of true wealth, which is 1, distinguishing between assets and liabilities, facts and opinions. 2, understanding cash flow versus capital gains income. 3, utilizing good debt and taxes to build wealth. 4, taking charge of our financial decisions. Make sure to leave a comment. If you have any questions, let us know. Thank you for having me. I'll talk to you next time. Bye for now.